if we had X percentage of the people withdraw within 60 days after that withdrawal, we would have a 40 to 60% uptick in our program. I mean, a huge run. It was like literally, and it had a 96% accuracy rate. So whenever the people would pull out, take their money out and move it somewhere else, we would have a tremendous a rally in performance.
Hey, it's Rocky. Welcome to Richer Soul. Today's guest is Katie Angle, who's going to share how to keep your head in the investing world while everyone else is losing theirs. Imagine it's 12 months from now, and you've achieved your major life goals. How does it feel to be in the best shape of your life? To wake up energized, excited about the day? To have great relationships and friends who support you and propel you forward? How does it feel to have an excess of money, to be able to make the choices you want? To be fearless and open to trying new adventures? Imagine being connected to the universe and it providing everything you desire. It's possible over time, and your past does not dictate your future. The only thing holding you back from this vision is you. It's time to take control of our thoughts and use them to our advantage. Welcome to Richer Soul, where we achieve our dreams and create harmony to health, wealth, relationships, time, and spirituality. If you have not had a chance to listen to episodes 1 through 9, I encourage you to go back and listen to the framework behind Richer Soul and how to create the life of your dreams. You can also find all the show notes for this episode at richersoul.com. Today's quote is from Thomas Fuller. Money is the best bait to fish for man with. Isn't that true? Money makes people do crazy things and fall for so many scams. It's got so much emotion tied to it. Greed, envy, jealousy. The reality is, it won't make you happy. And if you spend your life chasing it, you won't be happy. As we learned in our last episode. Speaking of our last episode, Rod's action step was to set goals. Look, if you don't have a scoreboard in your life, how do you know how you're doing? How do you know where you're going? We call that the drift, and it happens in every part of life. I set all kinds of goals, and my longest ones were set over 30 years ago, back in my 20s. You know what? I hit them, and actually by a multiple, because what they originally were, I had to keep upping. Every time I hit the goal, it was push it higher. It's not an never-ending chase, and you enjoy the journey along the way. We're back to wealth building today. It's a lifelong process, and what worked before may not work tomorrow. I've been through enough cycles to know that how you invest in each cycle is radically different. So you always have to keep learning, figure it out, have a plan that fits you, and make changes as you change your goals. Remember, you get to display wealth or build wealth, and very few people can do both. I notice many people think they can beat the markets. Some do. Maybe it's because they're lucky, maybe because they're good, but you really don't know until the game is over. What I mean is a strategy can work for 10 years or 20 years, and then it goes bust. And some of those people lose it all, and that's not good. Investing is also full of noise and emotions, and learning to turn that off is difficult. I know controlling my emotions and money has been a learning curve. The other thing is there are bubbles everywhere, and today we see lots of them. At some point they go pop. Don't know when. The Fed's been very proactive about making sure they don't, but they can only do so much. History has proven that. Today, we're going to dive into this, hopefully share some insights that you can use to improve the way you invest and build wealth. Inflation's going to be a game changer. We'll see how the Feds and the markets react. Our guest, Katie Angle, was introduced to the markets while watching his father earn millions of dollars in the gold market in 1979. He later founded his own asset management firm that has generated over 150 performance awards from leading industry performance ranking services using his own unique investment strategies. He went on to start a commodity futures newsletter in 1985 that became nationally ranked as the best in its field by independent ranking services, as reported in Forbes Magazine. He's also appeared in many different articles in stock and commodity magazines and futures magazines, and he's been featured guest on CNBC and Reuter TV. Let's meet KD. Welcome to Rich Your Soul, Katie Angle. It's great to have you join us today.
It's my pleasure. Thanks so much for inviting me, Rocky.
And I'm excited to learn from you. We always like to start at the beginning. What was it like when you were growing up, and how much did your family and school teach you about money?
My father was a huge influence on me. He went into an orphanage at the age of 5. He came out at 11. He got his first job at 12 and bought his first car at 13 during the height of the Depression. His old orientation to money is that the more I make, the less people can screw with me. And so it was a barrier between him and those people in the orphanage that basically abused him for 5 or 6 years. So his orientation was very like that. And I think first generation people, first generation wealthy, they identify greatly through the wealth that they have. And to me, it's a big mistake. Second generation people have a chance to look back and say, life's more than important than money, and you get to kind of broaden your sense of values and see the mistakes that your parents made. But nevertheless, he believed in hard work. He believed in he was a millionaire by the time he was 32. He was in the oil business, found his own oil, and he became very successful as an independent oil operator in Kansas. He later sold some oil production, bought some, created the world's largest liquid helium plant. And that's a whole nother story, but he was a big thinker, big doer, big risk taker. He happened to be an alcoholic as well, which kind of in some ways benefited him because he took on so much risk and he could take his pirate juice and just got through things. But at some point that catches up with you, and it did create a lot of dysfunction in the home, which I've spent a lot of time trying to unwind during my own personal journey. But and I've been successful at that. As far as my exposure, he sold that helium plant and had $2 million sitting in his bank account. And, he was always looking for something to do. It was 78. He decided to invest in the gold futures. He'd never done any market investing before. And he bought at around, I forget the price. It was November of 78. It was around $200. And then he rode that up to, he had $100 million by June of the next year with that $2 million investment. And so now he's an expert, because if you make that much, you have to be an expert, right? and so it impressed me. I put my first gold trade on. Of course, I was going to be the antithesis. I shorted my first position because my dad can't be this right all the time. So my first trade was actually a short position in gold. Of course, I lost that out in April of that year, and he ended up closing that position out in January of the following year, 1980, on the high at around 800 and I think it was $57 or something, and closed out about $65 million from that. And so because oil runs out, it's a finite resource. A lot of the wells that he had drilled were, eventually kind of getting down to stripper level, 2 or 3 barrels a day. I decided to look at markets as a means for my career path, and started then learning and reading and whatnot about what to do. And he had a lot of newsletters. And so these newsletters cost anywhere from $50 a year to $5,000. And I read all these letters, and it sounded like I could write a better letter than these guys. So I did start trading. I did start learning about the futures markets, and that's how I got, because it was my first experience. And that's how I got involved I started a newsletter, and it got picked up by a ranking service. I did well the first year that I did that. It was 86. That got picked up by Forbes. And when that article came out in Forbes, within 90 days, I had subscribers in 8 countries. So it kind of blew up in a very fortunate way. And then I dabbled around in the oil business a while, but I realized that if I could really figure out what the markets were about, I'd have an opportunity to be in a career that would never kind of run out, so to speak. And so it was me against the markets. I like that kind of playing field, and that's really kind of how I got into the business.
So, couple questions on that story. First off, did your dad teach you anything specifically about money, or were you just watching what he was doing and he was kind of sharing it? Was there?
He could not short. He could not understand how you can sell a market and take advantage of falling prices, which is a problem for some people. He had, I don't think, read a single book. He just knew that inflation, every time the inflation rate would come out, the Saudis would raise the price of oil. He just knew we were in an inflation bubble, and he thought the best way to take advantage of it was the oil or the gold market. The problem with gold, and we're back here again, 50 years later, whatever, it's gold responds last or late to an inflationary period. It is a hedge on inflation, but not long term. It kind of has its own little popularity fest where people can take advantage of rallies and whatnot. So long term, it's not as efficient as people would like. It doesn't pay a dividend, doesn't pay interest. So I'm not a huge gold bug or anything like that. I just know it has its place in time when inflation becomes a serious problem. We're kind of back into that window right now.
We are. And I remember what it was like back then, and interest rates went to 18%, and things were crazy. We'll see what happens going forward and how this all plays out.
To answer your question, he had a gold trade, and then he bought gold again for another run up after that first run, lost $20 million on that trade. And then he had another soybean, because he had 15,000 head of feeder cattle on feed. He could hedge with very little margin, and he ended up losing another $20 million being long in a bear market in gold or in soybeans a few years later. And he stopped. And by then he had invested all these banks and whatnot, borrowed money against that, and he ended up eventually just going into the stock market because he felt like he was too much of a novice for the heavy hitter that he was doing in futures. And he actually made some pretty good money in the stock market later. Did I learn anything from him? Mostly what not to do.
That's okay.
Yeah, exactly. It's like a buffet. You take what you want, you leave what you want, that kind of thing.
You talked about first generation, and I've seen that with immigrants. And you talked about second generation. Any thoughts on third generation?
Yeah, because I've got 2 sons. They're in their 30s. Fortunately, I did raise eagles. I didn't raise sheep. We butt heads a lot. That's what that means. They have their opinion about what, and the thing is that as long as you respect each other, they're both very smart. I listen to them both intently because my generation that grew up with X, Y, and Z doesn't really apply that much today, but the markets really are a function of emotion and how things tend to kind of repeat themselves. So you have to kind of combine the two together. It's a very fascinating position, I think, as you get older, if you're functioning, to kind of listen to your kids, if you respect them, and then combine that with what you're trying to do now so you don't look like you're completely out of step with what's happening, That's one issue. But as far as the third generation, I think if you instill values, work is a good thing. Working smart is a better thing. Working smart to the point to where you don't have to do anything is stupid. And a lot of people think that, and neither one of my kids were spoiled. We let them do what they want to do, pick their own careers, pick their own colleges, and gave them a lot of freedom. And I grew up, my kids up in the Northeast of the United States. Totally different environment than everywhere else. It really is. It's all about preparation to the point to where you can't fail. It's about getting to the right school to where when they apply to the HR director at some corporation, you're in the thin pile rather than in the thick pile. It's all about that. And to me, it takes a lot of the fun out of just the mystery of life. You know, everything's so pre-planned that no one makes a decision. It's all pre-planned for you.
You're on someone else's track and you might find out it's not going where you want it.
Yeah, exactly.
So you were in the newsletter business. You had some lessons you learned about people from that. Could you share?
I felt that if you performed, I still think this way today. And even my youngest said, Dad, it's not about performance. It's about politics. That even if you do well, you can't necessarily break in or rise to the top. And I go, I just can't buy that. I'm still a performance guy. My father believed in that. And as far as the newsletter business is concerned, I felt like if you did well, people would come to you. And that was great. But very interestingly enough, is that my renewal rate, even though year after year I performed, was only about 15%. And I couldn't understand why. So I have to plow all this money into marketing to rebuild my subscription literally every year. And so I contacted my competitor, he was a well-known guy then. I don't know if people still would remember him. I'm not going to mention his name, but he had thousands of subscribers and I had a few hundred, and I had to replace 85% of them every year. Called him up and I said, why do you have so many subscribers? And he goes, oh, well, you're selling a newsletter based on performance. We stopped doing that years ago. What we do is we sell a problem and then we make our newsletter the solution. It has nothing to do with performance. And I go, that's the formula? I was just shocked. I was speechless. So he says, that's it. I got off the phone and I'd say, well, I can't do that. But I did grind through the newsletter for several more years, got out in 95, and had the best track record during that period by giving specific recommendations to all sorts of interesting people, both professional and retail type clients, and then basically decided that if you got to, I had to replace the discipline. I couldn't provide the discipline, so I got into money management for that reason. You have to have discipline with a plan, or you don't really have a plan, do you? So that's what I decided to. The reason to get out of the newsletter business and get full time into the asset management business. That was in the mid '90s.
His name wasn't Lou, was it?
No.
Okay. I know somebody who was in the investment newsletter business for years.
Yeah.
And they were just running tons of. I just was wondering if it was my friend. That's all.
Yeah. Very good. Very good. No problem.
It's funny because you were in the asset manager business, and there is one thing I've heard from people in that business is when the clients start bailing and disappearing on you, it means that the markets are about to skyrocket and that good times are coming. And we're supposed to buy low and sell high, but human nature is buy high and sell low. I'd love to hear your thoughts.
Well, you're absolutely 100% correct. When we were trading, we were managing money for retail in the beginning, and they were brought into us by brokers. So the broker controlled the relationship. I never spoke to the client. We just got their account and traded with their program. And you say, well, that's great. It takes all the burden off me. Well, I don't have a relationship with all these people. And so we did that for about 10 years or so. And every time we had a low point in performance, you can measure it. And then within the next 60 days, it was not based on performance. It was based on pullout. If we had X percentage of the people withdraw within 60 days after that withdrawal, we would have a 40 to 60% uptick in our program. I mean, a huge run. It was like literally, and it had a 96% accuracy rate. So whenever the people would pull out and take their money out and move it somewhere else, we would have a tremendous a rally in performance. And so the last time this happened, we lost literally like 80 to 90%. We lost our whole business. And it was just because we were down on the year about 9%. Not much, just not really going anywhere. And then they call their broker. The broker says, well, I've got a guy that's hot over here. So he's constantly moving them out of kind of programs that are not doing that great over to programs that are peaking. And so he pulls them out. And I told my guy at the time that worked for him, I said, just keep running the product. We don't have a business now. We'll figure out what else to do. So in the next 60 days, we were up 100%. So it's just, people really should be careful. And this is why I got into systematic design and still am a big believer in it, that if you don't have rules to follow, the ups and downs of performance will definitely trigger your emotional makeup and cause you to do really dumb things at the wrong time.
I know. I've done many of them.
Oh, I have too. I've done just about every stupid thing you can do. I've looked at every technical indicator and tested it. I spent my first half of my career just kind of getting through all of that. That was my first 10,000 hours. And then you figure out, okay, now none of this stuff works. I got to figure out what I'm going to do now if I want to stay in the business. And you go to the mountaintop and say, I need to be creative here and get something that's original. And that's really, during that period is when I really decided that we can't trade anything that's in a book. We have to trade something that we create ourselves.
You have to understand the system and what you're doing and
correct
why you're doing it. And
exactly.
We'll dig into that
sure.
quite a bit. So we're here about your book. What inspired you to write the book, Guillotine Investing, Keeping Your Head While Others Are Losing Theirs?
Well, I wrote a book back in the late 80s or mid 80s that was about my father's $100 million trade. And I wrote that really just to record it. I was lucky to find a publisher, and that came out. I wrote another book for the same publisher about 10 years later called S&P 500 Trading Mastery. And then it was basically a spinoff of what we were doing with the S&P at the time with systematic trading. And then the thing about writing a book, if you're going to write one, it takes a lot of time, and per hour you make about 2 cents an hour. It's not a real profitable thing, but I figured out at this point in my life, books is going to outsurvive me. Wouldn't it be nice to have at least a statement of my knowledge in one book to where people can read it and say, hey, if I want to learn anything about the markets, maybe I should read this book as well to pick out what I can get to where I can find my own path to go, because that's ultimately what everybody has to figure out. So I wrote the book as kind of a legacy piece for the knowledge that I've accumulated up until that point in time.
And that's a great reason to do that. And having read the book, there is quite a bit of knowledge in there. I don't know what the right way to say this is. Getting involved in markets and doing this isn't easy. It takes a lot of thinking, and I think the average person thinks they can just play the markets and win. The reality is you're competing against people who spend billions and who have spent years creating systems. And I don't know why people think they're better than them, which is playing on the weekend or whatever, or just, tossing a dart or whatever it is.
Well, the one thing that I've known, and I've traveled a lot over the years, different countries and different cultures, but I will say the one thing that stands out about America's value system the most is we like it quick and we like it easy. And if it's cheap, it's even better. So, those three things are never compatible with something of great value. You hear about Edison and perspiration and inspiration through perspiration, hard work and all that. We just aren't a culture that wants to sit down and go, oh, I got to read that. I got to do that. Oh, they just want it easy. Just tell me the quick stuff. And I got to tell you, this book was originally about 3 times as big. And I showed it to an editor and goes, you can't sell a book this large. You have to shave it down. And so, okay, we'll just start slashing. So it's something about our culture. I think human people, with the expediency of phones and technology, and you don't have to wait. You can just get the app. You don't have to do this. You get the app. Everything's so instantaneous that I fight all of that as a person, personally and professionally. I feel like if it's going to be quality, you got to sit down and do the hard work. You just got to.
And I think that is kind of the comment that came up with regards to Robinhood and everything that went on last year, and the ease and they put a lot of emotional triggers into playing games, so to speak. It's been an interesting couple of years just during COVID.
Really has. And you're right about you're competing against highly educated. Just go to eFinancial Careers and look what they're trying to hire. Got to have PhD, got to have at least 10 or 15 years of experience. These are people that are designing strategies, and there's a ton of them, and you're competing with these people. And so you have to find your niche through all this traffic. Say, look, and you have to ask yourself, there's a checklist. Okay, how much time do I have to do this? How much capital do I have time to do this? And you don't know what the real answers should be. You're just trying to evaluate where you're at. And some systems require a lot more money than other systems. Some require more diversification. All these things that go into building a machine that you can rely on that actually build wealth, all these things have to be knowns. They can't be guesses. And that takes time and a lot of work.
It does. And I think most people don't like to create a system and follow it and take the emotions out of it. But that is literally how you do this. And it's not talked about. The systems that I use for my personal investing don't have emotions in them. And every time I put emotion into them, I'm wrong. and I've learned to find a system that works for you, that's based on good rules, and then just run it. And don't try even to improve it, because more often, the more you try to improve it, the more you break it. And just let it be. Love to hear your thoughts.
When we were starting out in the retail management business, we had a lot of people that were looking at systems all the time back in the 90s. And I said, and we had great research capability and had spent a lot of time doing that and had a lot of tools to break down strategies. And so we just gave it as a free offer to our clients. If you find a strategy that you're thinking about buying, send it to us and we'll evaluate it at no cost, because what's going to happen is you're going to get in that thing, you're going to get into trouble, and then you're going to take the money I'm using to help feed that thing that you think is more important, because the returns are sold as having, being better or higher. So the strategy part of learning even how to do research, that's the second 10,000 hours in my view, is to how to do that. And I don't want to sound like I'm some smart guy or that I'm some just really exceptional guy, but I'm so passionately driven that when I got out of my last asset management situation, it was just me and my own capital. This is where the rubber really meets the road. You're not trading with somebody else's. You're just you and your own capital. So I went back and spent a lot of time thinking about what would I want to put into a product that I can live with, that I can sleep with, that is right for me. And so that made a lot of difference as well, because people I need to understand is that when you're working with a capital source, institutional client, whatever, they have priorities that may be incompatible with what you think should be done in the strategy. And so you're constantly going, well, we can do that. And this is part of Rocky, this is the golden rule, that the person with the gold decides what the rule is. That's part of that deal. You're not whoring yourself out. You're just basically saying, okay, this is their objective. What can we do to get there? And in this business, there's trade-offs every time. You want to trade less, you're going to get this result. You're going to want more accuracy, you're going to get this result. All these things are interconnected, and it's kind of like 5 fingers with rubber band attached to any one of them. If you move one, it's going to affect all of them. So it's I just wish people would simply, like, I have a friend, this is basic stuff, but she's really good at picking stocks. She's really great at it. But I said, do you ever just open the chart up and see if it's in a downtrend and just say, well, maybe I'll wait till it bottoms out before I buy? And she goes, never. And I said, well, you should do that. And that was like 15 years ago. She still doesn't do it. And then she gets mad when she buys and the thing goes down. If she just would have waited a little while longer, maybe until it bottomed out, then she could have made a smarter timing rule getting in. So timing's important. And to me, timing is everything. Anybody that says you can't time a market just doesn't know what they're talking about. That's my career in a nutshell. You got to be able to time your way in.
Timing in and timing out too, right?
Oh, and out. That's true. Because your biggest risk comes from big profits. You've got this huge open profit there generating. Now you're up maybe 15, 20% on your capital. If it comes back on you, now you've given up 15 or 20%. and you think, well, I'm going to hold it for the long term. So you're right. It's getting out is as important as getting in.
Well, let's talk about that. I think you had an example in the book with the coffee trade.
Yes.
Love for you to share about that one.
It was the first $1 million that I took out of the market with client money. We were small. We had a lot of retail people. And what that means is that we're not using a fund. They're all in with their own individual accounts. And each night they get a printout of what their account's doing. They know they're in. So as coffee, it was, I think, 96, 97, maybe around that time. Coffee had a great move up and then really good move up. And the clients started calling saying, when are we getting out? And I said, well, you paid me to follow the plan. The plan says stay in because it could probably go higher. And then each day there are more and more people calling and calling and calling. After about 3 weeks, we had 3 or 4 times more money in open profit. And they were threatening to pull out so they could take their own profit. I said, look, if I don't follow the system, you could probably sue me because that's what you paid me to do, right? Right. Okay, let's just follow the system. We came out with a nice, really great profit, a career profit for that point in time, but people couldn't take it because they knew what they might be missing out on if we didn't take profit. And this is another example is that, most systems lose more times than they make profit. Their accuracy is less than 50%. My accuracy today is probably closer to 25% are profitable, 75% lose money. Well, how do you make money doing that? Well, your profitable trades have to be 3, 4, 5, 6 times larger than your average losing trade. So you really manage your losses. Don't care about how many we lost this month or in terms of number of trades, but we know over time the trends will offset the losing trades that you have. Most people today that are hyper traders, they want to be right more than they're wrong, so they want a 60% accuracy rate. So they're taking very, very small profits, but it just takes one large loss to wipe out a lot of profitable results. So this is how those traders get into problems when they are trying to be more right than profitable.
And I think that was a lesson I learned from Nassim Taleb, where when he talks about investing, he talks about, let's say he makes 100 bets, 95% of them, maybe 98% of them lose money. But when they lose a very small amount of money. Those 1, 2, 3 that win so big that you're done. And these trades do not happen often, meaning, or I should say the wins don't happen often. But when they happen, they're so astronomical that you don't have to worry anymore. So it's kind of that same thought process.
You're correct. And I've listened to a lot of his lectures online. I love a lot about what he says. When he worked for Goldman Sachs, they had a rule that you couldn't have a loss greater than your first standard deviation. Okay. In math terms, that just means a really small loss. And so a lot of problems is that in most strategies, your second and third standard deviations, think of them your second and third level of losses, don't come from banging out losing trades. They come from your profitable trades. And people don't know how to manage that profitability to a degree to where you can keep your losses still under the first standard deviation. So their rule was no losses over first standard deviation. And if you do that, you're really keeping yourself out of trouble. But when you design a lot of long-term trend following strategies, it's really, really hard to pull that off. It's almost, for most, it's almost impossible. It's very hard.
It is. And that's one of the things that I've learned from the strategy I use. The biggest advantage of the strategy, it's not that it does great on the upside. What it does do is limit the downside. And so you never really lose big. It's designed to lose small and then just let the upsides run. And again, it's not that strategy is not designed to do it like Nassim, where you make a killing. It's just slow, steady progress over time and let compounding do its work.
Correct. And a lot of the strategies have, certain things that I don't agree with. I don't believe in profit targets because that limits your upside. And so when a market takes off, people say, well, I got 20% on that. Well, on that particular trade, that's great. But what happens on those trades, like those few percent trades that you're talking about with Taleb, to where, one trade might generate your whole year. And so if you cut those short, you really have to ride those things really a long time. And that's where you get the benefit of hanging on to the profitable results. I don't use the term winner because I feel like that puts you in the camp of the casinos. I've never used that term. I always feel like it's either profits or loss. It's a business. So as far as taking profits too early is a problem, that's one thing I don't agree with. The problem you get into with a very good trending market is that you've got this huge profit and now how to manage that out. That is something that almost no one talks about. There's a chapter in the book about unrealized profits. And to me, almost no one, I've never had a conversation with anybody on how to manage your profitability. There's stop placement, there's this, there's that, when it comes to charts and other mathematical approaches. But as far as knowing when to manage your risk and really what you're doing, what you're talking about, what Taleb is talking about, how do you manage your risk? And most people don't see the risk that they're creating. To me, waking up is a risk.
It's funny that you say that because there was it wasn't a commercial. I think it was a YouTube video. Mm-hmm. And they were basically saying, hey, look, you can make $100 in the stock market right now with no money. Here, just come here and sell this option and you've got $100. And these people are doing it and they're like, I got $100. And I'm like, do you have any idea of the risk you just accepted by selling that option? And I don't think they had an absolute clue that they could get entirely wiped out. No, I'm a little shocked because I've been regulated my whole career, and everything we say has to be qualified with a counterstatement and certain language, and just to get on willy-nilly. And I've talked to my regulatory body. I go, how can these yahoos get on YouTube and say you can make $1 gajillion? And their answer is, well, they're not members of our regulatory body. We can't regulate. This is a freedom of speech issue where they just go out and say whatever they want, apparently. There's a reason I'm not licensed.
Okay, sure.
Today's episode is sponsored by Profit Answer Man Podcast. Did you know that most small business owners hate looking at their financials? It's one reason they may struggle with business success. The Profit Answer Man podcast helps them ensure they are profitable and can pay their employees and weather the storms we all have to face. It's built on the Profit First methodology of pay yourself first. The Profit Answer Man podcast is a must listen to for every small business owner and anyone who wants to help them survive and thrive. Check it out on your favorite listening platform. I knew that when I started this, I knew that if I got licensed, I would have major issues. And I'm like, I'm not going to be able to tell people the truth. And so I was like, I'm not dealing with all this regulatory stuff. I'm not getting licensed. I will just teach people. I don't take their money. I don't invest it. So it doesn't really matter.
Sure.
But it allowed me to stay away from that. And I never really wanted to handle their investments. My thing is more, hey, I'll show you how to better generate revenues. And then once you get them, I'll teach you how to look at your investment strategies so you can say, yes, that's reasonable. No, that's not reasonable. Or you're being taken hook, line, and sinker on that one. And for the example I gave, I would say, hey, do you realize that if this happens, you're going to lose all this money? You make a decision. I don't make decisions for people.
But you're self-filtering, Rocky. You're and a lot of these people that have something to sell, like, hey, if you contact me right now at this link, or you call this an 800 number and leave your credit card info, all this is about something else, and so it's a big problem, and so when it comes to freedoms, once you sign up that I'm going to be regulated, you've lost a big chunk of your ability to do much of most things.
You have.
Yeah, it's true. So I totally get it. I totally get it.
So how do we filter out the noise?
I'm so sorry. I'm so sorry. I'm so sorry. It was such a great, it just hit me. Sorry. I'm so sorry. I haven't had that belly of a laugh in a long time. Okay. How do we filter out that? Well, I haven't had television for almost 18 years. I don't watch television. That was self-filtering. Let's get rid of that. I used to be on these talk shows out of New York, MSNBC, CNBC, at a time it was called FNN. It was these things have graduated into major market distributors of noise. So I go into people's houses that are friends of mine. They got 3 channels blaring with the noise. I'm going, it would be nice if you just could turn that off. Maybe we have a conversation, think about what's going on. Because what taught me a lesson when I was in the studio there in New Jersey, and I was on regularly. They would bring out a limousine for me out to my Connecticut office and take me in, and I would be that 5 or 8 minute talking guy saying, what do you think about the close today, or some stupid thing that I'm supposed to give an answer to, which is totally different than what they asked me to talk about when they booked me. And so we're waiting to go on there, and these talking heads, everything they say is written down. Now, if everything that came out of your mouth, Rocky, was on a teleprompter, wouldn't you sound intelligent all the time? Pretty much. We all would, But that's what these guys are doing. And then at the end of the show, I'm sitting there waiting for my car to come and pick me up. And there's 4 or 5 reporters in the newsroom going, the market was down today. What are we going to say? Now, they're probably in their early 20s. What are we going to say? The market's down. They're writing the content for these people to read. So, let's say book squaring. And to this day, I still don't know what book squaring means. I've been in the business forever. So it's just the idea that most of the information that's being pumped out of here is not accurate. It's going to drive your emotions, and you have to just basically filter it out of your life and be very selective about who are you going to expose yourself to. That's to me, that's because there's a lot of noise, a lot. That's why I laugh so hard. Sorry.
No, I know that. And right now, I think the biggest noise is crypto and NFTs. And it just amazes me how many times we go through these types of bubbles. And I didn't realize that there are constantly bubbles happening, and that this is not something out of the norm, that every couple of years, there's another bubble in something. And most of them we probably don't hear about. This time it's getting to be extremely noisy.
Well, I'm asked about crypto, and my response to that is, okay, you want to buy some crypto, or you own crypto? Is that a currency, or is that an investment? What is crypto? Have you ever seen a crypto coin? No. Have you ever, could you use crypto without somebody else? Is it a personal currency certificate? No. You have to have some sort of electronic linkage into this Bitcoin system that, by the way, uses as much electricity to run the Bitcoin server as the state of Washington, which to me is more of a climate hazard than anything. But it's unbelievable. So there's a lot of faith and in the perception of the value of crypto, just like there is in our own dollars. There's faith in that. That's a dollar of stored energy, and that's what we look at.
And we're going to get to that in a couple of minutes.
Okay. All right. Okay.
Because that's one of my notes that I want to talk to. But before we do, I just want to kind of just focus a little bit more on the markets. One of the things you say is to spend more time out of the market, but that's really contrary what we usually hear, because you got to be in it to make money. Time in market is what is the most important thing. And the reason they say this is if you miss the top 10 days, maybe, I don't know the exact stat, you lose like the majority of the market's gains. And what they never tell you is the 10 best days usually come after the 10 worst days. So you had to take a haircut to make it big on those days. But you say spend more time out of the market.
Well, what they never tell you, and there was a real popular commercial that was on a long time ago, and people talk about this, wealth managers control most of the money in the country. The big clients give them money, and then they just say, wherever you need to be, that's where we've got to be. And there's tons of those offices everywhere. They don't want to deal with people getting in and out of the market. They just want to basically manage their overall big picture allocation approach. And that's fine. That's fine. People that have stayed in have really benefited from it. But in terms of I forgot what we were talking about. Sorry.
Staying in the market versus out of the market. Thank you very much.
Yes, is that the situation with that is that what they don't tell you in that commercial is that if you would have missed the 10 worst days, you would have tripled your returns. See, then no one talks about that. They just say, if you miss the 10 best days. Well, what if I miss the 10 worst days? And I'm using this is a theoretical. I used to know the exact numbers because that was an important thing to talk about at one point in time. But no one talks about how much you lose. You can avoid these downdrafts. But at the same time, what a wealth manager will say was, how do you get back in? Well, that's an issue. You got to have a plan to basically restructure your portfolio, because people like Warren Buffett never get out. They own for life. But he's lost his net worth 3 times over the last 30 years. 50%. 50% of his net worth has been lost 3 times.
How do you avoid the down markets? How do you know to get out?
My approach to trading is that I don't need to know the fundamentals. I don't need to know the news. I don't need to know what the supply demand scenarios are. The price has it all there if you'll just pay attention to it. So if prices are going down and they continue to go down and they continue to down more, then, the price will lead you there. So my approach to design strategy is that I don't have to know. I don't have to know what the news is, but I do know what the price is doing. And so it's a matter of figuring out ways to get into the market, get out of the market. In the stock market, it's a matter of just avoiding the downdrafts. Like in the first 2000, 2001, 2002, that bear market loss in S&P lost 50%, 54 or 5%, somewhere in there. Well, if you'd have just avoided those 2 or 3 years, you would have not really missed out on the returns because the markets were basically trying to find a bottom. The fall of 2003, you just start rebuilding your portfolio there as those things bottom, the trend started going up. You would have done much better than trying to hold through the whole thing, because from 2000, the price of the S&P didn't exceed. It took about 10 or 12 years for it actually to increase over that time period. So paying attention to timing can really speed things up without just the buy and hold. I'm going to hang on forever and it'll work out.
Depends on which time frame, and it'll work out, but it doesn't mean you're going to grow and have total success. One of the things that I think people really struggle with, there's all these measurement tools. I notice you say in the book that most of them are horrible.
They are. Sharpe ratio, if you study what it's measuring, it doesn't give you any benefit if you've got more upside volatility than downside volatility. The Sortino ratio is another popular one, where you basically include your desired rate of return. Well, what does that mean? Your desired rate of return. When you break some of these things down, a lot of the tools that are on these trading platforms, they just aren't very good because, the reason they're not good, and I'll give that some of these technical tools, Rocky, is that they're a shadow of what the market's doing. They're not anticipatory in any degree at all. They're basically following the market. So if you're going to sell, that's one thing. The thing is, I would never short the stock market, because typically when they sell off, the sell-offs are sharp and they're quick. And so in the futures market, you have all these stock indexes. I'm not a big fan of shorting stock indexes because it's by the time you get short and try to get out of that short, you probably lost money by the time the market's turned around. So part of it's knowing overall behavior. But in addressing your last question, when you look at a year beginning to year end gain or loss, a gain, I'd say on a stock, most of the gain is made in only about 13% of the days. That the other time it's back and filling. So there's a lot of sideways action that goes on. And so you try to stay out of if you're not already in, you want to get in when the markets are bottoming out and trending up. And then you want to basically not try to trade the chop so you can get the benefit of the long-term value. But knowing that the markets really only move directionally about 13% of the time should tell you that there's a lot more risk from the remaining portion than there is from the directional portion that you're going to benefit from.
And you start off the book with the analogy of how long does a baseball game really take to play?
That's a great way to bring that up, because did you guess right?
I was pretty close. Yeah. Well, it's funny because I used to coach soccer, and what we would tell the kids is your foot on a ball during an average game is probably like less than 30 seconds.
Yeah.
People don't realize that. There's very little time. Most of the time and soccer moves a lot faster than baseball does.
The reason I put that in is to the first chapter talks about the movie Moneyball and some of the things that people do in sports, and how it's an observational problem, meaning that people aren't seeing what is actually there because they're focused on another objective. They've got peer group pressure. They've got cultural pressure. They've got habitual judgments that have been instilled in them. This is how you do it. And what you need to do is say, okay, the original premise when you start with the markets is I'm going to hang on to my profits and cut my losses. And it's still the same today, but the way I view that, one thing I have to be careful about when somebody asks me a question is that 50 things fly into my head and I can't give them just a 1 or 2 sentence answer because I know all the context and BS that goes with trying to answer that question. So it's paying attention will get you a long ways, not just with the markets, but I use that in every aspect of life of trying to pay attention as to what's actually going on.
So we have a standard response for our clients, and the response is, it depends.
There you go. That makes sense. Yeah.
So one of the other things you talk about, you say volatility is good. That's not, most people get upset stomachs over volatility.
Totally. Volatility is great when you're making money, and it's really horrible when you lose money. And what a strategy is trying to do is trying to, besides meet with your personal value system when it comes to risk. That's really what a strategy should do. Otherwise, you can't believe in it, you can't trade it. But when it comes to vol, everybody hates vol. Well, I love vol if I'm making money, and I don't like vol when I'm losing money. So all you have to do is that when vol gets into the market, if you're on the right side of the market, let it work for you. That's why it's a good thing. And then if it's a matter of risking a very small percentage of your overall capital in being wrong, then you get out regardless of whether it's high vol or not. Typically speaking, though, most markets will consolidate. They'll be quiet. They'll move sideways. You don't want to trade that chop. You want to try to figure out, okay, when it moves out of that, then it's more efficient to get in during those periods of time. And most people understand this. It's just hard how to figure out how to do it. And then once you're in it, the volatility brings your position more profitable. And now you're worried more about losing money than you are about making money because you've got this profitable result. And then people get in there and say, well, I've got to override my system where I've got to get in there and take it before I lose it. But the volatility should come after you're in the markets. I tend to try to avoid getting in while markets are very, very active. You want to be in the market by the time that happens. And so that makes the roller coaster ride. And by the way, I have air sickness. I have motion sickness. I hate roller coaster rides. I'm not a gambler. I call myself a calculated risk taker. And so I'm not one of these guys that I'm up $1 million a day or down $1 million. I've never done that. So it's just I I like to be able to sleep at night and enjoy the process. And it's the process that you really fall in love with. And you wait to enjoy that. You have to avoid doing really dumb things during high volatile periods.
So speaking of that and high volatility, I'd love to get your thoughts on where are we at currently? What do you think of the current market situation?
Well, you're talking about stock market, I'm assuming.
Stock market, yes.
Yeah, and well, we've come up. I look at the stock market. I trade it. I'm familiar with it. And as far as, if you go back to 2009, we've just done nothing but go up, except for the COVID hiccup that lasted 6 weeks. And most people that stayed in during that period of time were better off than people getting out. So that's one of those situations where because the volatility was there, but the duration was so short, it didn't pay to get out. So what it does is that's enforcing people's minds that, I should always stay in, or I can always buy the dips and it'll always reward me. And so when you get this kind of mentality going over time, then the market's designed to take the most money from the most amount of people. To me, that's how it's designed. But it just hasn't done that yet. It's kind of like you pull on the lever and it's still not paying off. Well, at some point, the stock market is going to stop trending in a bull market, and we're going to have a real bear market that'll last anywhere from 2 to 3 years. So that's my take on the stock market today.
Is there a way to tell when that's about to happen or it's starting to happen?
Sure. I don't like single trading. I don't like trading single markets on their own, meaning that if you're going to say, I'm going to trade the S&P, that's a single market. I like a basket because now you're spreading your bets more thinly. You're not concentrating on one horse. It'd be like betting on, I don't care what one horse race is. I'm going to bet on the 15 horse races today, and then my results at the end will be my result rather than looking at one race. And so you have to look at each approach to the market that I don't want to be in just one market. I don't want to trade just the NASDAQ or the S&P 500 or the Dow. I want to, and this is the problem with ETFs, because the problem with the ETFs is most people don't realize that like 7 or 8 markets control the S&P so you're not really, that means that those markets are so strong, it's offset a lot of deadwood in the S&P 500.
Today, more than ever, I think the S&P 500 is full of so much deadwood.
Yes.
And people don't realize that.
Correct. And so what I think is that if you're using a basket, let's say you've got maybe the Dow 30 stocks or the top group of the NASDAQ 100 stocks, you want to be in. I don't like ETFs because I'm just afraid of what the fine print doesn't tell you, because most of those things are trying to mirror what the market's doing. And I would rather own the stock if I was going to trade stocks, and then use a basket of, you don't need more than 20. If you got more than 20, then you're just diluting yourself. It's like salt at dinner time. Dilution is great until it gets past the point of helping you, or diversification is. And it's like salt. You just keep pouring it on, and then it ruins the meal. Well, diversification's like that too. So I believe in diversification, but to a point. Limited diversification is more my taste in terms of putting together a portfolio.
Since we started with gold, I'll ask about it again. I mean, we're clearly coming into times of inflation, temporary, long-term. I've given up guessing because I'm usually wrong.
No, but gold's been really kind of a head-scratcher for quite some time. If you look at it in terms of years, we had a rally, I think it was up to the 2006 period, and you could say that we're in a rally kind of here from about, several years back. But the main thing that I get asked is, what can I do to hedge against this stupid inflation? Because I just happen to be really fortunate that my whole career started with the inflation thing, and now I'm back in it, and I have the right tools to take advantage of rising prices in commodities, petroleum products, meats, grains, metals. So these markets are really starting to really take off. And so that helps offset my purchasing power, because I've thought about this a lot. How do I protect my purchasing power if I didn't have this. Okay, own a home, anything you own, cars, land, real estate. I mean, it's a physical item that will go up because of inflation. You got a point.
Can we talk about real estate? Because this one's interesting. And the reason it's interesting is people today don't buy a price. They buy a payment.
Correct.
If interest rates go up, are they going to downgrade the house they buy, or are they going to bid lower for the house? In other words, does that asset then decline because people can't afford it, or does all of a sudden corporate come in and buy them all up because that's what they've been doing?
Well, the stock market goes up because there's nothing when there's nothing to compete with it, like say bonds, interest rates. The stock market will go up. Inflation's another competitor to the stock market. It's not at this point. When it comes to real estate, you're exactly right. People are saying, "What can I afford per month in order to buy this thing?" It's a very all the stocks have to do, or all that has to happen, is that interest rates go up just a little, and it will destroy all this opportunity for buying real estate, and it will kill the market. It just has to. Now, it won't at first because people will be chasing this inflation thing for a while, but the gold will respond more and more at the end of this inflation cycle than anything else, and that's just the way it works. You might have a relatively rising market, and we've kind of come up somewhat recently, but it's with the inflation that doesn't go into housing or that by that market. The only way to really hedge it, if you don't have you got to have something that the government can't dilute in value, and that's what gold's for. I'm not a big fan of it, but there are times when having that to hedge, and I just said I don't like ETFs, but the GLD ETF is one it's like a stock. You buy it, you've got a gold exposure. I don't encourage anybody to do futures. It's my specialty, and I told my son the other day, he was looking at what he should do with his extra money, and I just said, look, futures or markets aren't for everything. You can become an expert at investing in other things. Why don't you start putting together a real estate portfolio? And he's young, he's making good money, and you wake up 20 years later and you've got this nice portfolio of rental opportunities that you've created. So, I mean, there are other things you can do. Don't lose sleep over the markets if you think that's the only thing that there is. I know a lot of people that have, and the problem with the stock market and this low interest rate thing is that only 11% of the country owns the stock market. Yes. Now, have they become wealthier than they already are over the last? Yes, I know people that their net worth has quadrupled over the last 15 years just because they have huge stock portfolios and they just let it accumulate. And so the problem I think about is you measure the health of an economy by the state of their middle class. And the middle class wage today, adjusted for inflation, is lower than it was 40 years ago. And that, to me, is a serious problem that the Fed or the governments aren't addressing. The health of our middle economy is everything, in my view. Not how wealthy you're getting as a rich person, or how the wealthy are doing, or how the stock market's going up. It comes down to, can that middle class person have a life, or are they just on a treadmill making a living? And that's where we're at. That's a problem.
You mentioned the Fed. I'd love to hear your thoughts on kind of what's going on and how they're doing.
Well, I see the Fed as the Wizard of Oz behind the curtain. And as long as everybody believes that the Fed is intelligent and all-knowing and all-foreseeing, then that perception will continue to foster the policies of whatever the Fed wants to do. The problem with the Fed is that they don't know any more than my cat. And so they're constantly following what the market action is. They're behind always. And it's gotten more and more political. Their decisions to go to zero interest rates means that all of the people that saved their whole lives aren't getting any benefit from it. They're driving them into risk assets. And the real reason why the gold goes up is when real interest rates are negative. Not because of inflation, but if you take the yield of the 10-year note, subtract the inflation, if that number is negative, that's destroying capital. Now that's when gold really is in its own, not just because of inflation, but it's when that negative real rate is where it is now. I think the negative rate now is probably -6. And it's been like this for about almost 2 years because of the low interest rates. And so why hasn't the gold gone up more? Well, I guess it's just not feeling the pressure and people don't feel compelled to go in and buy it. What will really become a problem with inflation is when you start buying toilet paper because you know next month it's going to cost. You're going to buy more this month because you know it's going to cost more next month. And that's the psychology that we got into in the 70s. And people really will fuel the higher prices just by buying changes in their buying habits. And that is when inflation really becomes a problem.
And we shall see what happens.
Correct.
I do know that as I read about every single stock market crash, the underlying issue was generally that the Fed got it wrong.
Correct.
And that's what caused the crash. And so
they're way behind the curve here on raising rates. They need to just figure out that we need an interest. Don't we need an interest rate industry? I mean, I think we do. I mean, this zero is ridiculous. And it just it's like they've taken away that industry by just going to zero. And I don't understand where they think the long-term benefits is that going to come because it can only do nothing but damage.
They are trying to prop the economy up because they don't want a negative economy. I have always said you need winter to have spring. We have prevented winter for a little bit too long. And so when it comes, it will be long and cold. And you mentioned that earlier.
Correct. Now, my two sons are in their 30s. Neither one of them are advocates or believers in capitalism. They don't want an alternative. They don't know what the alternative is. But the capitalism that we have today is not the capitalism that I had when I was a kid. And capitalism is the creation of businesses through competition to drive down prices of goods and services. And then some of those people don't make it. They go out of business. Now, once you start bailing people out in the capitalism world, you've now polluted the efficiency of capitalism. And that's where we're at today. It distorts the real value of having competition because each industry now is controlled by 1, 2, 3 conglomerates that dominate an industry. And it's today, self-employment is at about a 50-year low.
I did not know that. I thought it was going up with.
Well, lately it might be in the last few because of COVID. But overall speaking, you're going to make more money working for somebody else, or at least that's been the trend, than working for yourself because it's so hard to go from nothing to something.
It is hard to go from nothing to something.
Yeah.
We always like people to actually do something. What is an action step people can take this week to move forward in their lives?
Oh, well, I think we got to go back to the laugh of the interview. Turn off the noise. I look at my phone as a phone. I turn it off regularly. It sits in another room. I don't use it for anything other than taking calls. And so the phone is now turned into this kind of computer that can just distract you from everything. I lived in Lake Tahoe, literally on the lake for about 12 years. I'd go down to the lake, see a couple sitting on, this is a true story, a couple sitting on a beach or sitting on a bench looking out at the lake. Both of them are looking at their phones. I know they're tourists because this is what people from cities do. The people in Lake Tahoe don't do this. They sit on the bench and they had a dog their dog was looking at the lake and enjoying the view while they're looking at their phones. And I just looked at the dog and go, I get it. and so get your mind out of the noise. Most of it's, you can't, the news, what's the news for? None of it's reliable. It's you Google it based on what you search. It's what kind of news you get. That's not news. That's something else. So turn off the electronics. We're basically worshipers of technology as humans. We've always been like this. And so just unplug all of that and start seeking out your own quiet time to reprogram your brain. And that may sound like a real kind of a generic, altruistic thing, but I think it's really valuable to be able to use your brain and think.
It is. You know what's funny? My phone is on silent, and I don't usually leave it near me. When my kids want me, like they'll call my cell or they'll text my cell, and then they'll realize he's not going to answer me. So they call the house phone. And because the house phone rings, and so then we'll actually pick it up because it's just the way of the world these days. I don't want the noise.
Well, during their 20s, they never picked the phone up, ever. I mean, they just, that was a problem because all this communication equipment and nobody's communicating. Now in their 30s, at least they'll pick up and say, I'm busy, or I'll call you right back. Or, they're at least starting to pick up. It's interesting.
You know what's funny? My kids don't like talking on the phone, but they'll FaceTime. Like they always want to FaceTime. That's how we communicate.
Interesting. Okay.
So it's video chat. They're all in. They usually won't do it just on a telephone.
They make time for it, though. They dedicate time to doing that, which is good.
They do. They want it scheduled. And I'm like, whatever. We'll get it done.
Scheduled. Exactly. Turn off the noise, man. It's awful.
That it is. It's time to learn the secrets of life. What's your secret to living an abundant life?
Not caring about the money. It's all about the juice that you get from the squeeze from doing. Because if you do it what you love, I don't think I've worked a day in my life. I've been working 12 hours a day right up until just a couple of years ago. Why? Because I've enjoyed what I do. So just, I think that's it. The money thing to me is a benefit, is the afterthought, is what comes with the work. Now, if you want to become a professional tap dancer or something, or something that there's no paycheck in it, then do that. I'm not just saying that everything has to evolve around a paycheck. I'm just saying is that I just happen to be interested in something that I can possibly have a chance at making money at. I have other interests that I do, but and I pursue those. But at the same time, I think to me that's the secret of not getting all caught up, because I know so many people that are wealthy and all they worry about is how much they're going to lose or how much they need to make. And they've got more money than you could spend. If you spend $1 million a year for the next 100 years, who cares? Everybody ends up in the same spot, man.
That they do. And you should have fun in life. It's short.
Correct. Yeah, it is.
What did you learn later in life that you wish you would have learned sooner?
The word no is a muscle. If you just say it enough, it bends to work for you. And people know that you're capable of saying no. That applies to business, personal relationships. Just say, no, I'm not going to do that. That's all right. I'm not. It becomes a muscle. And you can worry about upsetting somebody. You can, create a turmoil. No, but if you just say, and a lot of it's how you sell it. You start smiling. Yeah, that's a great smile. There you go. You start smiling. Go, no, we're not doing that. It's a really crazy idea. I'm not doing it. So I think maybe just learning how to. My dad was he was a kind of guy that if you were in a meeting and he didn't like how it was going, he would just say, I'm going to take my jacket off right now and just whip the snot out of everybody. And I'm going, and I've been in those meetings where you have to kind of like, it's okay, we'll just leave now. My dad's done, and we'll do the deal. And I was kind of his mop-up fireman kind of person that could communicate. I remember he did that to a couple of Japanese people that were there trying to sell us steel. And when he stood up, they didn't know English very well, and they hadn't been into the country very long. And here's this guy's getting ready to take his jacket off. I said, it just was such a bizarre situation, but you don't have to treat people like that. You can treat them good, treat them well, and still. But I get impatient with support phone call operators, and those are my worst days. I wish I had somebody do all those calls.
I agree with you. It's funny. Parents have no trouble telling their kid no 1 million times.
Yeah, exactly.
If you were to give an 18-year-old one specific piece of wisdom, what would it be?
You're probably going to have more than one career, because most people start out thinking, I'm going to chase this carrot, and that carrot goes away, or you hate it. I love those stories where the guy graduates from law school and realizes on graduation day he doesn't want to become a lawyer. I mean, good for him. He finally got his wake up moment. But at the same time, life's full of those stories. And I just have been, I guess for me, if somebody said, well, if you knew what you knew about this business, would you have done it? I said, no, because I think I would have been successful a lot earlier. Would have gone through a lot less angst. When you've got a mortgage and a family and kids and they're growing up and you're trying to make a living through kind of an unconventional approach, it's hard to do that and not have a bunch of stress. But, I feel like you got to learn to live with the stress, because the only people I know that don't have any stress they're dead. And so you got to learn to live with it. Be chill. Don't dwell on it, and get up and I do some positive affirmations, different ones all the time, every day. I just feel like to tell yourself to replace your inner voice that's constantly telling you to jump off the cliff with a verbal thing saying, no, you go back to sleep. I'm gonna be happy and do this. I think it's really important for humans to do that regularly.
And that makes a lot of sense. If people would like to learn more about you, the book, what's the best way for them to do that?
Well, look, the book is all I've got going. And at the same time, I feel like it took about 3 years to write it and get it done. And they can find it at guillotineinvesting.com. If you don't know how to spell guillotine, then I can't help you. It's kind of an IQ test to filter out the dumb people. Sorry. But anyway, I think it's a well written, and it should be a good read. I had one guy in Canada said that his head exploded on every page. I don't know if that's a good thing or not, but he seemed to like the book a lot. So anyway, that's where it's at.
I enjoyed it very much myself. Thank you so much for joining us today.
Absolute pleasure to invite me. I appreciate it.
I like how Katie looks at things very differently than most investors. And let's face it, most investors don't get rich off of investing. They actually do something else to generate the wealth and then park it in the markets. Or they make money off your money. Do you have a system that you use to invest? How do you make decisions? Or do you just turn it over to someone else to manage? If you do that, how do you know they're any good? The last 10 years are a bad gauge because the markets have been on a tear. We've had many past episodes where we talk about this. Todd Tressiter, Dr. Daniel Crosby, David Liu are just a few that come to mind. And as always, money won't make you happy, but it will give you freedom. This week's action step was to turn off the noise. Maybe your phone, your computer, the TV. I highly recommend this. We don't have cable in our house. My phone is always on silent. I will admit I'm far from perfect on the computer and social media and email. They do waste my time, but I'm getting better. Where can you turn off the noise and just enjoy life? When you make that small change, life gets interesting when you're present and in the moment and still. We have an upcoming episode on that very topic. However, next week we're sticking with money. We've got John Mitchell on to talk about Think and Grow Rich, the $5 million, 12-minute-a-day secret. And he's going to share it with you. Check it out. Hey, can you do me a favor? If you enjoyed today's episode, who do you think would appreciate it that you could share it with? I know I would appreciate it if you did that. Thanks for listening. Have an abundant week.